Welcome, I'm Michael Bickert. Thanks for joining me today as we explore concepts with the objective of improving your management skills and growing your business. Now, I hope you have a notepad and a pen handy so that you can take notes, because I want you to make a commitment to yourself that you will jot down some sort of action item that you can implement in your business today. Remember, that's what this is all about, implementation to drive your business forward. Recently, I was involved in a discussion in which I was asked to comment or remark on some of the issues surrounding fundraising for small and medium-sized businesses and exit strategies, succession plans. There was a whole discussion, and I'm going to try to do that justice a little bit here, but it's such a broad topic and people come at it from a variety of different ways. I'm hoping you'll get something of value out of this as it pertains to your business, because I think the discussion, just sort of engaging in the discussion and giving some thought to it, is really good for entrepreneurs, for business owners, for managers. Give some thought to these issues. All right, so let's start off with the concept of what about if I'm trying to raise money for my business? Now, I've got a whole video, and I don't want to repeat all the content on various ways to raise capital for your business. So visit that video, but of course you can take out loans, you can sell bonds, and you can solicit investment from angel investors, venture capital, and from friends and family, and you may even be able to take your business public. There is a lot of different reasons why some of these things work better than others. But let's look at things. I like to have a discussion from first principles point of view, or looking at things from axioms that we can fall back on time and again as we are exploring concepts. That way you don't have to memorize everything about business. You can just sort of accept some more philosophical principles about how the world works and how indeed business works within the confines of those principles in the world. So the first thing I think about is if you were really trying to raise some money, if you were trying to get investment in your business, what first principle would I go back to? Well, commensurate value exchange is the first principle I would look at as it pertains to any exchange. Remember, no one is going to engage in an exchange of any kind unless their perception is what they are receiving exceeds the value of that which they are giving up. And this has to happen on both sides. So for you, if you are trying to get money, you're trying to engage in an exchange where you get capital, some financial capital injected into your business through investment or a loan or something like that, the other party needs to perceive what they're getting back is more valuable than what they're giving you, and offsets any risk as well. So that value has to take into consideration the risk equation. And the same thing goes for you. You want to make sure that what you're getting, maybe it's needed financial resources. Right now, I need some money. I need some financial capital to get things to expand, to increase my capacities, or to continue to go. Things are coming down the pipe and it looks like things are going to be going good in the future, but we're running low or cash flows are low. Whatever the case may be, both parties in the exchange want to ensure that what they are getting in the exchange exceeds the value of what they are giving up. So when you put yourself in that position and you consider all the various ways that people do look to raise capital, you're gonna have to, as the business owner, you're gonna have to be empathic and put yourselves in the shoes of the person to whom you're going to try to raise money, whether it's a lender or it's an investor. What are they looking for? And there are far greater resources out there than me to give you really granular details in terms of all the ins and outs of creating the perfect package in terms of investment strategies and that kind of thing. But I do like I said, the discussion will help us to explore some ideas in your business. So let's take a look at just some of the basic things an investor may want in terms of trying to make sure he's getting more out of it. You know, if I was going to buy a business or a portion of a business, I would look at things like, well, what are the assets? What am I actually buying? What physical assets are there? You know, maybe there's equipment, maybe there's real estate involved. What physical things appear on the balance sheet? And, you know, that's a whole nother topic, but the way things show on the balance sheet, I would want to explore that a little deeper and find out if the actual value, maybe something was depreciated. They had a aggressive accounting strategy and they aggressively depreciated something and it's worth perhaps far more than what it shows on the balance sheet. Or conversely, maybe something wasn't really taking into effect on the balance sheet how much depreciation has occurred. And so it was skewing, distorting the amount of assets that the business actually had. What other types of assets? Maybe they have some liquid assets, some inventory, they have money in the bank or currency in the bank, and these types of things. And so you can add that stuff all up and you can see, okay, well, here's what I'm actually getting, and this is what the value of the business is from a assets point of view. And then the other thing you would need to add to that is some sort of blue sky or potential. So you would think, okay, so you might look at historical sales revenues and profitability, and you might assign a multiple to that. Like, okay, well, I want to earn this percentage on my money, so this business earns $100,000 net profit per year, and I'm buying 10% of the business, so I could expect to earn $10,000 net profit per year, and you just assign a multiple to that, and you would be able to work and extrapolate backwards how much, by adding the assets and that blue sky and the income earning potential together, that would give you an idea of how much you might be willing to invest. The other thing you'd be looking at is the trajectory the business is on. Is it likely to grow? So all of these things factor into valuations. Is the business growing year over year, and is $100,000 the average of the last 5 years, but it's likely to earn $120,000 this year, $150,000 the year after that? These types of things would factor in, and this is the way that people do valuation. There is one other factor, and that more sophisticated investors may consider, and that is future value based on something known as network effects. And think of that as user base. So this is very common in technology businesses. So when Peter Thiel was the first outside investor in Facebook, for example, and Facebook wasn't making a nickel. They weren't profitable at all when Peter Thiel's venture capital fund invested in it. But what they were looking at was the network effects, all the user base. There were lots of people coming on board and signing up for this, so they knew they could later assign a business model to that, and they could then extrapolate money for that. So there is the more fundamental look at valuation, and there's more speculative look at valuation. And so the speculative is like, well, what is it worth now? What is it likely to be worth in the future? And that's far more risky. And so what a person, of course, you understand that there's an inverse relationship between risk and return. You're expecting the more risk you take on, the greater risk I guess that's not inverse in that case. The greater risk you take on, the greater return you're expecting on your money. And where it's more fundamental, where it's the kind of thing like, well, boy, looking at the financials of this business, I'm likely to receive pretty predictably this amount of money. That is more fundamental investing and a little more straightforward in terms of coming up with a valuation. Another thing that investors may look for, and this has to do, I think this is the most relevant for many of you small and medium business size owners, and especially those in startups, is investing in the person and the implementation of the idea. Now, investing in an idea strictly by itself, I would really advise against that, and any sophisticated investor is not likely to invest very much just in the business. They're going to want to see what is the business plan to implement the idea. And so when we talk about a person investing in an idea, really what I think they're investing in is the person who is going to bring the idea to fruition. And that is much more common with people that know you. So someone who knows you really well is more likely to say, I believe in this person. I know their history, I know their track record, I know how motivated they are, I know how passionate they are about this idea and how hard they're going to work on it. So I'm going to that's where these relatives, the proverbial grandmother investment, that kind of stuff occurs. So You can appreciate that when you are trying to persuade somebody. It's sales and marketing again. So you're trying to convince somebody that what you're offering them is worth more than what they're giving you, and that they should make the exchange. And so there's a little bit of marketing, sales, persuasion, influence that's involved in this. That's why there's more regulation that surrounds public trading, and there's a whole bunch of hoops you'd have to jump through before you could have an initial public offering and start trading on a stock exchange, because that would enable you to put out, so to speak, the marketing message to so many people, and you would be able to raise money from a lot of people who may be unsophisticated or retail investors further removed, and it's much more distributed, and those people are relying on government regulations and everything to sort of temper and mitigate the risks that are involved. But I'm sort of getting off on a bit of a tangent there. What I mean to say conversely is, when you are raising money for your business, a small business, privately, you can go to your friends and family, and there are regulations surrounding what you're allowed to do, because there is this idea, the premise behind less regulation on that is that the people that know you, it's a lot more buyer beware, and that you'd be very transparent. Hopefully in both cases you're very transparent about representing the assets of the company and all the various details that influence the value of the company. The main key I'm trying to get across here is that if you're expecting, as a small business owner or startup, to get investment, you're very unlikely to get any sophisticated investor, any angel investor or venture capital. Even you're very unlikely to get a loan from an established bank or a lending institution if you don't have fundamentals that you can prove. If you don't have sales, you don't have a track record that they can look to. And you see this kind of thing on shows like The Dragon's Den or Shark Tank. They're looking for, well, what are your sales and everything? And often the people who present on those shows, they have an idea, but they haven't manifest anything with that idea. They don't have anything to show yet. Those are always the deals that don't go through. So in that case, you're more likely to get, have to go to grandma. You're going to have to go to a spouse or to your friends. And those people who believe in you, who may know much more about you, are more likely to take that risk, because it's not, in their case, as much of a risk. Now, there are, I'm sure, venture capitalists and angel investors out there that pride themselves on being able to spot talent and be able to invest in the man, not the idea, and invest in the man, not the fundamentals, and they've done very well for themselves. But you can appreciate, the more you know somebody, the better you know somebody, the less risky. You're not relying on your intuition so much. It's like, no, I've known this person my whole life, I trust them, and I'm going to invest. So that was just sort of a overview of looking at the various things that people on the other side of the exchange are going to be looking for. And then, as you look inwardly at your own business and the efforts that are involved, it can be very discouraging in the business, or in the beginning of a business, trying to build. And that's when it's really good for you to look forward and sort of look at 5 years, 7 years down the road and ask yourself, what is my exit strategy? What is my plan? Do I have a succession plan? And are the efforts I'm putting in right now worth it right now? And the answer for every entrepreneur in the early stages are no. You are underpaid in the beginning, big time underpaid. But it's in the hopes of being far overpaid in the future. You're going to have a residual income. You're going to be able to leverage all the efforts that are going into building a business right now for you're building the golden goose, so to speak, or you're raising the golden goose, I guess is a better metaphor, that will pay off time and again once you've got it built. And so that is sort of the perspective you can think of for yourself, to encourage yourself to continue to invest in yourself, invest in your own business right now, because you know down the road you're going to be able to capitalize in or cash in on those investments time and again, and you can relax and back off a little bit, perhaps hire a team that's going to do a lot of the things that you're doing. You're wearing all hats in the beginning. You'll be able to delegate and decentralize as your profits, as your growth warrants it. You will find it is a bit of a futile effort to try to convince a distant investor, someone who doesn't know you really well and believe in you, that they should buy into the 5 or 7 year plan. They're not going to. They're going to say, anyone can say that. Anyone can show me projections down the road of what they should do. I want to look to your history. And if your history substantiates your projections into the future, then, a more sophisticated investor will buy into that. But don't try to tell somebody, no, look, here's what's a percentage of the market we can have, and it'll result in this if we are able to pull that off. That's not worth anything. Those are just projections. Those are pie in the sky dreams. You may have a really good plan and everything, but you're not going to convince somebody to buy into that unless they know you very well. So that's I think, in a nutshell, how I would approach it in terms of if I was looking for outside investment, who you're going to go to, who you're likely to get that from. And then just think of where we started this, the axiom, the first principle, commensurate value exchange, and people always operate in their own best interest. That's the other axiom here that you have to grasp. And so people, you don't know what it is that they're looking for. If somebody has dormant resources, maybe I have a lot of financial capital that's not going to work for me right now. Maybe I won the lottery, maybe I sold a business, or I'm struggling to come up with good examples right now. Maybe I had an inheritance and I'm looking to invest. I'm looking to put that capital to work, and right now it's just sitting, earning no interest in a savings account in some bank or whatever. Then you look to that person and you put yourselves in their shoes and you imagine what it is. Now, if a person has far more money available to them than they'll ever need throughout the rest of their life, then they may have different, they will almost assuredly have different interests than a person who needs to be able to live for the next 30 or 40 years if they're in retirement off of a fixed income and everything. So consider these things. Or maybe you're seeking investment from someone far younger than you, or somebody that has a lot of talents and everything. Maybe the investment you can get from them isn't financial. You can get their time and their talents, and they will maybe dedicate working toward your business for free as an investment. So give some creative thought to how this might work and who it is you're approaching for investment, and what they want out of it. Everybody's asking, what's in it for me? And they want to make sure that they get more out of it than they're putting in their mind, their perception, and everyone acts in his own self-interest. These are really important axioms to default to as you consider this stuff. Liquidity, investors are often considering, well, how can I get out of this? So maybe you think, well, I'm in my business for the rest of my life. And we have a whole video on succession plan, and you should have a succession plan. And you want to, if you get hit by the proverbial bus, if you were to die tomorrow, what would happen? Would your business die with you, or have you got a plan in place? But investors are looking to know, well, how can I get out of this? If I decide I'm no longer interested, that's one of the reasons people are in the stock market. It's very liquid. It's very easy. You can just, make a trade instantly on your smartphone and be out of it. It's very liquid. Whereas investing in your business for an outside investor may be like, well, if there's nothing to show for it, if the idea is still panning out, you may be doing a great job of implementing the early stages of your startup idea, but that person believed in you, but now they need the money. They have immediate, urgent need for access to that money. There's an emergency in their life or whatever, and they can't. Where are they going to find someone else who believes in you the way they do? So it's an illiquid investment. So consider that. And when you're approaching people and you're presenting to people and you're trying to think win-win, think commensurate value exchange, put yourself in their shoes, be empathic, and ask yourself and ask them. be upfront and ask, what is it that you're looking for, and then design your presentation around that. So make sure when you're doing a presentation, when you're approaching people for an investment, you always give consideration to their point of view. That's all that matters. And sitting there, it's a futile endeavor to just tell them your perspective and your how optimistic you are. Now, passion and enthusiasm is contagious. I get that, and you definitely want to bring enthusiasm into your presentation. But if that's all you have, then you're not going to get very many people other than those closest to you who are interested. So, I hope you got something out of this. I think where I want to leave it today. I don't know if I did this justice for, the person who asked me to comment on this. I do understand building a business in the early stages it can be very frustrating. It can be a little disheartening because you're not getting those returns at the early stages, and you need to look further down the road. And that was part of the discussion that came up. And, what is this going to be worth in the future? And you need to remind yourself of that. And perhaps as you're taking on outside investors, you need to remind them of that as well. So you can look to some of those smaller things, those more granular details. Like if you are creating network effects, if you are getting more and more engagement from people in the market, or if there is some reason that you can point out that helps to explain and justify why you don't have the sales and revenues right now, but you are very likely to because there's going to be some big change in the market, that kind of thing, then you want to introduce that. But I'm just continuing the discussion, but in the interest of time, I think I want to leave it at that, and I'd like to hear from you some comments. Have you tried to raise money for your business? Who did you go to? What were the main ways that you decided you were going to present and try to engage in getting people interested in investing in your business? Do you want to push back on this? Do you have some ideas that we should elaborate on in the future? Leave all that stuff in the comments, because when the community and there's other people, other entrepreneurs and business owners that read your comments, we learn, and we need to learn from one another. Perpetual refinement.